So options trading for beginners. So in this video, I'm going to talk about iron condors. So how to trade iron condors with Questrade. So if you haven't watched my previous videos on options trading for beginners, I'll link it below in the description. So go check it out first to make sure that you'll fully understand this video on iron condors. So I'm going to look up the option chain for SPY, make sure I'm under option over here, click SPY. And then under this section here where you see calls and puts, I'm going to go to multi-leg options and I'm going to choose iron condor over here. And then I'm going to choose the expiry that I want. So for example purposes, I'm just going to choose November 20th. Now an iron condor, so if you've watched my previous videos, an iron condor is basically the combination of a vertical call spread and a vertical put spread. When you combine them, when you do them at the same time, it's called an iron condor. So if I go back to iron condor, I could basically choose anywhere, any strikes that I want, but I could adjust them later, so it doesn't really matter. So I'll click anywhere, click buy and sell, and then automatically the order entry window updates. So like vertical calls or like any option trades or strategies, I can buy an iron condor or I can sell an iron condor to begin with. To open the trade, I can buy it or I can sell it. So if I buy it to open, then I have to sell it to close. If I sell to open, then I have to buy it back to close the trade. And they each have different consequences or different assumptions. So let's first look at buying an iron condor. So SPY is at 330 right now. So let's say I were to buy the 340 call option and then sell the 345 call option as well for November 20th. So right here, I've got a call spread. So this is a vertical call spread. And then on the put side, I'm going to sell the 320 put, and then I'm going to buy the 315 put. So I'm going to buy the 320 put, and I'm going to sell the 315 put, and I'm going to explain shortly what this means, okay? So here we've got a call spread, and here we've got a put spread. So this is a debit call spread, and this is a debit put spread. So I'm basically buying this iron condor. As you can see here, it says DR, so it's a debit. I'm paying $3.28 for this iron condor. But what is my max profit? So my max profit right away is the difference between the spreads. So 340 minus 345. The difference between the strikes, so $5. So my max selling price, sorry, not my max profit, but my max selling price will be $5. So therefore my max profit is the difference between $5 and 328, whatever I pay for this iron condor. So basically for this trade to win, my assumption is the SPY by November 20th will either be above 345 or it'll be below 315. So by buying this iron condor, that's my assumption. I assume that SPY is going to make a big movement, but I don't know which direction. So that's why I'm buying both sides. So I'm buying the iron condor because I don't know which direction it's going to move, but I know it's going to move hard. So by buying this iron condor, I make money, I profit, I start making money. If SPY come November 20th, come expiry, is trading above 345 or is trading below 315. But if it's trading between 340 and 320, so if it's trading below 340 or trading above 320, anywhere in between, I'm actually losing money. This $3 that I paid will decay and it'll be worth less, and it'll expire worthless if I don't take action and sell it. I will have lost money, but the money that I lose is capped to what I paid. So what I paid up front, that's my max loss. I'm not going to lose more than that. And my max profit is also capped. My max profit is $5 minus what I paid. So in this case, it's about $1.70. So if we look at the example, let's say SPY is at 350 come November 20th. This call option over here is going to, both of these strikes are going to be in the money. So this one's going to be worth $10 and this one's going to be worth $5. 350 minus 340 is 10. 350 minus 345 is 5. So this is going to be worth 10. This is going to be worth 5. And this I bought to begin with. I'm going to sell it for 10. So I'm going to make profit on this. So $10 is going to come in, but then $5 is going to come out on this one. So the net credit here is going to be $5 if SPY is at 350 come November 20th. And in this case, these put options are going to expire worthless because the strikes are below the market price. So this is going to be 0. This is going to be 0. So all this combined, I'm getting in $5 net credit, but I paid $3.28 net debit. So that's where my profit comes. So anywhere above 345, my max profit will be $1.70 because the width between the spread or the strike is 5. So I'm always gonna be capped at $5 to sell this call spread. That'll be my max selling price for this call spread anywhere above 345, 350, 360, 370, doesn't matter. On the put side, it'll be the same thing. Anywhere below 315, my max selling price for this put spread will be $5 and the calls will expire worthless. So if I keep the trade on together as a whole, then even if I lose on the call spread, I'm going to make money on the put spread. Or if I lose on the put spread, I'm going to make money on the call spread. But I only make money if the SPY ends up above 345 or ends up below 315 come November 20th. So that's the assumption you make when you buy an iron condor. And you're basically buying you're basically buying the first call, the first strike, and you're selling the further call. So the closest strike is what you buy, and then you sell the further strike, because that's how you end up paying a debit. Because as you can see, leg 1, the green one here that I'm buying, I'm paying more. I'm paying $5, and then the one that's further, I'm collecting less. That's the one I'm selling. So this is gonna generate a net debit. So I'm gonna have to pay for this. And then same thing on the put side. I'm paying $6.80, but I'm selling for $5.48. So I end up paying a net debit of $1.50 or whatever. So combined, it's a net debit of $3.28. So on the put side, I'm buying the closest put and I'm selling the furthest put. So that's how to buy an iron condor. But if I wanted to sell an iron condor, same thing. I simply click on sell. Let's say I wanted to keep the exact same strikes. I simply click on sell. If I wanted to change my strikes, I just go here and change them. But then just by clicking sell, I've changed my assumption completely. And look, I'm getting a credit this time. Instead of paying, I'm actually getting a credit, CR. So this money will be deposited into my account right away as soon as I sell this iron condor. But this time my assumption is different. I make money as long as SPY stays below 340. So remember, when I bought the iron condor, I make money if SPY is above 345. Now I make money if SPY is below 340 and above or above 320. So anywhere between 320 and 340, I make money come November 20th. And my max profit is what I collected to begin with. So it's the same thing as buying an iron condor, but the opposite. By buying an iron condor, my max loss is what I paid. But by selling an iron condor, my max profit is what I collected to begin with. Now, what's my max loss when I sell an iron condor? It'll be the difference. It'll be the difference between the strike, so $5, minus what I collected. So my max loss will be $5 minus what I collected, which is $3.28. So my max loss in this case is $1.70. If I do one contract, so that's times 100, so $170 is my max loss. My max loss occurs when? If SPY is trading above 345 or below 315. My max profit occurs if SPY is above 320 or below 340 come November 20th. But as time goes by, if SPY doesn't move much or is trading in the same range, I could close this trade early. I don't have to wait till expiry to get out of the trade. So if I collected $3.28 and then a week goes by or 2 weeks go by and SPY is still trading at 330, this $3.28 is going to probably be worth $2.50 or even $2. So I can buy back this trade for $2, close the trade, get out of the trade, and I would have made a profit of $3.28 minus $2. So $128 profit if I did one contract. If I want to go to expiry, wait till expiry and collect max profit, then these would expire worthless if SPY is trading, let's say, at 330. Because if SPY is trading at 330, these calls are out of the money. So they're going to expire worthless, they're going to be worth zero. These puts are going to be worth zero as well because they're out of the money. The put is below the market price of 330. But let's say SPY is at 310, well then this put option is going to be worth $5. This put option here, the 320 strike, is going to be worth $10. So I'm going to have to buy this one back for $10 and I'm going to have to sell this one for $5. So that's a net debit of $5. These are going to expire worthless, so it's zero. So I'm paying $5, but I collected $3.28 to begin with. So my max loss is the difference of $1.70. And you can always adjust your iron condor depending on how safe you want to go. You could use delta, although I don't find that Questrade's delta is very accurate. The way I like to place my iron condors, if I do place iron condors, I usually do put spreads and I usually sell put spreads. But the way I like to do it is I like to look at the expected move. So right now SPY is at 330. I'll go look at the expected move. To get the expected move, I look at the value of the straddle. The straddle, well, let's go to November 20th first expiry. So November 20th expiry, the value of the straddle is about 20 points. So what I like to do is I'll sell a put spread 20 points lower than the current market price. So I'll go to 310. So I'll go back to vertical put, and then I'll sell a 310 put option, and I'll buy the 305 put option, and that'll be my put credit spread because I'm selling. And I'm collecting, I'm back to November 2nd, I don't know why, so I'll click on November 20th again, and I'm collecting 90 cents for that. I would collect 90 cents to sell the 310 put option and buy the 305, and I basically make money as long as a SPY is trading above 310 come November 20th. So if that's my assumption, then I could make this trade and I make money. I keep my premium as long as SPY is trading above 310 come November 20th. Now I lose money. What's my maximum loss here? My maximum loss will be the difference between the strike, so $5 minus what I collected. So let's say $1, let's say I collected $1. So my max loss would be $4 or $400 if I did one contract. And that'll happen, my max loss will happen if SPY is trading below 305 come expiry. So this is just how I personally like to choose my strikes, but this is a put credit spread. But an iron condor is basically a combination of a put credit spread and a call spread. And you could buy an iron condor or you could sell an iron condor. So actually, let's go to my account. I do have an iron condor right now on, for example, I've got an iron condor on Amazon, as you can see here, but it's an iron condor that I sold. So it's a combination of a put credit spread and a call credit spread. So what did I collect on this iron condor? You could basically just subtract this from this and then subtract this from this. So 28.97 minus 28.33. So I collected about 60 cents on the call spread, and I collected about $2 on the put spread. But as you can see, my put spread has been breached because Amazon right now, if we look at Amazon, is trading at 29.84. My put spread is at 31. So right now, this iron condor doesn't look too good because it's on the losing side on the put side. The call spread is fine. It's pretty far. I've got a 34.95 short call, so I'm fine there, but the put spread is breached. But I still have until November 20th, so I'm hoping that Amazon comes back up. Now, if Amazon doesn't come back up, what I'm going to have to do is I'm going to have to bring the call spread a little bit closer. And the way I would do that is make sure that I'm grouped by strategy, click create order. I'll remove the puts from the order entry because I don't want to do anything to the puts. And I would bring the call spread closer. So this entry here, the first two lines that you see over here, this is buying back my current call spread. And then I'm basically clicking add call to sell a new call spread. I would come closer, let's say, so I'd pick the same expiry first, so November 20th, and I would sell, let's say, the 3,300 call spread. So I'm coming closer to collect more credit just to reduce max loss, because my max loss, we already know what it is. It's capped. It's $5 minus whatever I already collected. So now I'm just reducing max loss because my call spread is profitable. So I'm just bringing it closer to collect more credit from the call side. Since my put side, it looks like it's going to be a loser, but I'm also giving it a chance to maybe come back and become a winner. So that's why I'm not doing anything to it, and I'm just selling a call spread to reduce max loss. So I said 3,300 would be my short call, so 33.05 would be my long call. So short means selling, long means buying. So 33.05. And then you could see here that to close my old call spread and to sell a new call spread a little bit lower, I'd collect about, so $1.55 minus 50 is $1. So I'd collect about 50 cents to do that. So I'm basically reducing my max loss by collecting more and more credit, but I'm not going to do anything right now. I still have time. So I'm just going to hold on to it. You could see that the value of the premiums have dropped. So I had sold the call spread for $28. So each leg, I sold the call option for $28.97 and I bought the other call option for $28.33. You can see right now it's trading for $10 and $9.75 respectively. That's because the stock has dropped, so the premiums, the call premiums will drop as well. So here's another iron condor I've got for this week, November 6th on Zoom ZM. My put spread was at 465, 460, and Zoom dropped below my put spread. So I ended up selling a call spread to mitigate this put spread. So now it has become an iron condor. So the call spread is somewhat, or should be somewhat profitable. The put spread is being completely breached, so that's not good. I could eventually bring my call spread closer to the put spread and turn it into an iron butterfly. So what is an iron butterfly? Basically, an iron butterfly is the same thing as an iron condor, except that the short strikes of the put and the call are the same. So as you can see, the short strike over here, which is the -1 that you see here, the short strike on the put is 465 and the short strike on the call is 495. If it was an iron condor, the short strike would be the same. So it would be 465 for the put, 465 for the call, which I do have here. I've got an iron butterfly on Visa. The short strikes are the same, 185 for the put, 185 for the call. Now, one thing just to be careful with is if your short strikes are breached and you're very close to expiry, depending on how in the money they are, they could get assigned or exercised early. So you want to just be careful with that. I've got a video in my options playlist that explains early assignment, so please check it out. So if you're afraid of early assignment, then you'll just have to close the trade early. So this iron condor, if I want to close it right now, I would have to close it for somewhere in between $2 and $4.50. So I'd have to close it for about maybe $3.25, $3.30. So I'd have to pay $3.30, but I collected in total credits. You could see if we go to my positions here, you can see that in total credits I received about 75 cents and $1. So I received $1.75 from selling this iron condor, and I would have to close it for $3.30. So I would lose about $1.50 if I close this trade right now. But I'm gonna hold on to it. I will have it Friday, so I have 4 days to go. I'm hoping for Zoom to come back up. If it doesn't, I'm gonna have to bring this call spread closer and closer and collect more credit. And what I already did is I actually sold a put spread lower, a put credit spread lower at 430, 425. So it dropped a lot. So my assumption is, okay, it's not going to drop more than that. So let's go even further, go to the 430 strike and sell that put credit spread. I collected $1.04. And if I win, as long as Zoom stays above 430 come November 6th. Now, who knows what's going to happen? It keeps dropping, but my assumption is it already dropped from 550 to 449. It's more likely that it's going to take a bounce back up. Yeah, so this is how you trade an iron condor with Questrade. So look it up, look up the stock that you want under option, click on iron condor, pick the expiry, and then you could pick the strikes that you want afterwards. You don't have to find these strikes over here. Just click anywhere, click buy sell, updates the order entry window, and then you could change the strikes you want and then decide if you want to sell first or buy first. All right, so if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also, check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.